Hello and good afternoon. I welcome you to today's Trading Spotlight webinar. Today on Friday, it's the 14th of February 2020. Happy Valentine's Day, everyone, by the way. And now a very, very important question. Can you hear me well? So usually everything should be fine, but as you probably have seen, is that I'm not wearing a headset today. And the reason for that is simple, because I started to use a microphone. Here some, yeah, such a thing here. and I'm not really sure whether you can hear me well. Okay, all good is perfect. So because I had some webinars in German already, and there people said that the volume was a little low, but everything's fine. That's perfect. So then, yeah, we can start right away with a very interesting topic. In fact, I have to be honest to you right from the start. It's a very theoretical aspect, where theoretical topic for me. The reason for that is I'm not someone who actively uses so-called harmonic patterns in price action trading. Still, as someone who is, who is a mathematician and who studied mathematics, and I'm in mathematics since, I don't know, I think 15, 16 or something like that. I did every course on school we had here in our system. And so Fibonacci's play a very, very important role here. I'll guide you through this, and I hope you enjoy what I present to you. And yeah, so let's get started. Here's today's agenda. We want to introduce harmonic patterns, in fact, and examples of also the most common and popular patterns. What I will try is I will show you first of all the theoretical background behind this, and also draw some of these and how you get there to find harmonic patterns. And then I will show you also such harmonic patterns within the MetaTrader. I've only screenshotted one, and so I hope that this is fine. There are plenty of indicators in the World Wide Web, so you can definitely Google harmonic pattern finders, and then download it there and import it into your MetaTrader 4, respectively MetaTrader 5. So there's one way where this is a certain way to get this, because after some time listening to this now, and also seeing me draw these lines and give an explanation why we do this and that here and there, you probably come to the conclusion that it sounds very, very difficult. In fact, there's an automated way by using such indicators. And that's something I already want to say here in regards to examples I want to show. And then also I want to guide you here through the question how to use these in your trading, then give you also an idea on not just draw them within the chart, but also draw trading conclusions out of that. So in regards to my person, yeah, my name is Jens, and I'm here as the moderator today. I don't want to dig too deep into any details of my person. If you're interested, feel free to check out probably the chat box right now. I'm not sure, but I will definitely share a link to an interview I gave to Admiral Markets that was in June last year, and there you get an idea on how I got started in trading, where is my background, and also what's my trading approach and everything. I think this is probably not so important and so interesting right now. What's probably the most important thing is that I'm located in Berlin, in Germany, and this is something which is interesting in regard to Admiral Markets. So Admiral is one of the biggest FX CFD trader trading, yeah, not venues, brokers. Yeah, that's probably a better word to put it. Brokers in the world. A financial service provider with over 8,000 financial instruments being offered, offices in over 20 countries around the globe. One, for example, in Germany, and also here in Berlin. That's, by the way, also one reason why I have this microphone right now, because we agreed on a project. I'm not giving further details on that, but we agreed on a project here, and in this regard, it makes sense to have a microphone, a high quality microphone. Yeah, and what's very important in regard to Admiral Markets is certainly that they have licenses, or that they are licensed by the FCA, for example, fully regulated by the FCA, in the UK. They are also regulated by the ASIC. This is the Australian financial authority there. They are also regulated by the SISEC. This is especially important now after the Brexit and no one really knowing in which direction we head here, to make sure that it does not affect in any way any client relationships. So SISEC is Cypriotic is EU, while UK is probably after harder Brexit, let's call it, or something, a topic. So Admiral is well prepared for all these developments here. And it's not only that, but it's also interesting to give Admiral a deeper look here. Someone, as I am, a professional trader also in Germany, located in Germany, when talking to others, not just clients, but also colleagues, traders, professional traders, we always refer to Admiral as the probably most competitive broker in regards to the DAX offering, especially with the highly competitive spread of 0.8 during the main trading hours. Admiral Prime, this is a solution I use, for example, is offering, especially for short-term traders and intraday-oriented traders, a 0.2 spread. With a commission on top of that, so that it adds up to 0.8 points also in regard to the total cost. What's also noteworthy in this regard is for FX traders especially, Admiral Prime is highly competitive here when it comes to the spreads being offered also. So we talk about one of the narrowest spread. I've run several tests with different brokers on external platforms to also know what's going on here in the broker industry. And it was, I knew that Admiral Markets is very, very competitive when it comes to FX trading, yes, but I didn't know that they are so competitive and probably one of the most competitive brokers out there also. So definitely worth a look. And that's it on the promotion now. Let's have a look here now at the question. What are harmonic patterns? And so harmonic patterns, this is the first point here. Harmonic price patterns built or are built on geometric price patterns by using Fibonacci numbers. You probably have heard about this. So as a mathematician, I need to write it that way. That looks a little irritating to some of you probably. Let's just probably do it differently and go here. So I prepared this already. Before we go here then to these Fibonacci levels, you've probably seen within your trading station when drawing retracement levels within your charts. Let's have a look here at Fibonacci's and make this as easy as possible to understand. So Fibonacci's, they are calculated. You can see this here. So you set FO, so the first number 0, and the second number you set it with 1, and then for every n bigger 1, you can calculate the Fibonacci number, which means you take, in this case, let me just go here, you take, in this case, 1, and then you add a 0 to this, and you get 1. This is the next number, okay? So here you have 0, 1, the next number is the 1. So in this case, this is, and now the problem is I can only write it that way. So let me probably do it that way. Probably this is better. Let me just see whether I can. No, okay, oh, no, wait a second here. I think this probably gets the job done. So there we go. So you have here this F2, okay? And there is this number coming from, so FO, or F0, F1, F2. And now what we do is to get F3, let me just try this again. Let me do it probably that way. It's not working. So to get F3 here, does that work? No? Beautiful. Okay, let's make things easier. That's probably better. So I add up 1. So I take F2 and add another number, which is F1 here, and then I get 2. We have here F4, and you continue doing that. So if you have F4, then you take 2, that was the last number, and you add the number before, you get a 3. Then I have F5, and then you have 3 plus 2, which adds up to 5, okay? And this is how you get the Fibonacci numbers here. So you continue doing this over and over and over again. And at the end, you have a series of numbers, which is then the so-called Fibonacci numbers. So, and the interesting thing now comes into play when playing around with these numbers. So mathematicians are not only calculating numbers and count them, but they are known to derive patterns from that, or find out certain behaviors and then prove these. Let's put it simply. Okay, so and what in the case of Fibonacci has become very interesting, Fibonacci numbers becomes very interesting quite quickly, is that you can now divide these numbers. So if you have ever wondered why and where, for example, the classic, let's call it classic Fibonacci retracement number of 61.8 comes from, it's in fact, you have to calculate them to a certain point to get a how can I say that? Accurate or more accurate number. But let's imagine you're here and you say, okay, now I divide 8 by 13. So you divide 8 by 13. And if we now use the calculator I prepared here, what you get, surprise, surprise, 61.5. Okay, so 615, and this is 61.5%. So what you can see is that these Fibonacci numbers, obviously, or these ratios, they come out from dividing here those numbers with each other. So the higher we get, let's say then 21 would be the next number, 13 plus 8. If you divide 13 by 21, you see that this number is now closer to 61.8 in this case. So it's already 61.9. And you keep on doing that, and the bigger the number get, or the numbers get, the more accurate you get this ratio in this case. So what you can also see, by the way, is that 50%, for example, is not a Fibonacci ratio, by the way. So you can certainly get the Fibonacci ratio here from those two, but the higher the numbers get, the more you will see that you're not getting an accurate number here in regards to 50%, in fact. So that's something noteworthy, probably. Still, 50% is a very interesting number from a price action perspective. So when someone asks me after, let's say, a run up in a structure of higher highs and higher lows, for example, in an uptrend, what I think is where should I try to enter the trade? I would say wait for a retracement, and here, after, let's say, a move up of 100 points, probably have a deeper look at it at around 50 points. So this is around a 50% retracement. So it's still a very important number. But when it comes to Fibonacci's and Fibonacci ratios, in fact, you will see that 50% is not such a number, in fact. But 38.2 is one. So what you have here is very simple. So you use, for example, 13 and 5. So you divide 5 by 13. Let me just see. And you get 38.4. So now you could also say, let's go one number higher. One sec here. One number higher. So let's go to 21 and divide 8 by 21. 8 through 21, and you will see now you have 38.1, and you also here get a more accurate number the higher the numbers get, and then you come out at 31.2 or 38.2. So now there's also extension levels when it comes to Fibonacci's, right? So it's also something you probably have seen. It's not only you are not only capable to draw Fibonacci retracement level, but you can also work with so-called extensions. When do I work with extensions, or do I work with extensions? That's probably a very interesting question in this regard. So I'm very careful when it comes to this. Still, there are occasions when I work with this. For example, when looking currently at equity markets and making new all-time highs, NASDAQ, Dow Jones, S&P 500, DAX in the case of Germany. So we are making new all-time highs. And how can you now find out, or what are the levels you should orient yourself at, and what should you expect in regards to a move higher? So there's certainly probably better ways to do it than by Fibonacci extensions. I, for example, work with so-called open interest levels, which are very interesting. When it comes to options, in this case, there's a chance in Germany, for example, the future DAX, the FDAX, and this is the reference market, for example, the DAX from Admiral Markets is referring to. When I look at the future DAX, I know that the FDAX is traded at the Eurex. The Eurex is the, let's call it the CME of Germany. So this is the stock exchange where the future DAX is traded. And it's not only the future DAX which is traded there, but it's also the options or our options on the future DAX which are traded there. And then there's a chance they give this information out for free. You can find numbers on the open interest. And currently, for example, when you're looking at the DAX, you can see that there's an elevated open interest of 13,800. So there's a high elevated open interest, which means there's a natural interest from those institutional traders, players in the market to hold the DAX below that level. Those options, they expire then next week on Friday. We don't dig too deep into this topic right now, but just if you have wondered, why is the DAX right now capped at 13,800 points? Have a look at your chart. You will see the market has trouble to break through this level. And I would say one of the main reasons for that is because those institutional players want to hold the DAX below that level, because now the next thing is happening. Once we break through this level, those institutional players, they have a problem of seeing their, let's call it, bets turning sour. So they don't work out anymore, and they have to hedge their exposure in this regard, which means that would push the DAX even higher than that, and then bring the next psychological level around 14,000 points, I think, or in my opinion, into our focus. But this is just how I work in those areas here. There's also another way, and there we work with so-called Fibonacci extensions. And this is when you just turn around these numbers here. So for example, let's have another look now at 13 and 8 here in this case. And we divided 8 by 13 and received 61.8, or in this case, in our case, was 61.5, but that was here in the range around it, that number. But now if you divide 13 by 8, what happens? 61 or 62.5. Probably it's better to work also here with a higher number. So when looking at, in our case, 21, the next Fibonacci number, and then we divide it by 13, you get already 61.5. So you can see, oh, by the way, I just see. So this extension level you have here is 161.8, and this is what you get when you switch the Fibonacci ratio here. The same is also true when you now divide 21, the next Fibonacci number, by 8, for example. Then you get, surprise, surprise, here, number near to 261.8, in fact. And this is how these numbers come into existence, in fact. So there's plenty of room for also adaptations. And some people might say, but I've also seen 78.6, for example, and everything like that. And I've also heard about the Golden Cross. We don't want to dig too deep into this. I just want to make sure that you understand where these Fibonacci numbers come from, because the understanding of these numbers is crucial when it comes to the so-called harmonic patterns, which we also probably have heard about already in case of Gartley patterns, bat patterns, butterfly patterns, crack patterns. So probably have heard about them. And what you will also see is that they are very, very close to each other. So there's no big difference between them, which means at the end, the numbers and the Fibonacci ratios we will use, they differ a little, but at the end, it's not set in stone. But a Gartley pattern can probably also be, to some extent, adapted. And finally, you're trading with a bat pattern, butterfly, or whatever. You will see that in a few seconds then. So yeah, that's it on the theory behind this. So what are harmonic patterns? And now what we want to do is we want to have a look here at the first two, the so-called Gartley patterns. And now the thing is, I've tried to describe how you calculate this, and you can, or let's call it that way. I would say it that way. I would say go through this yourself to get a better feeling of that. Not just read it, but paint it or draw it yourself to see how these numbers or how this pattern comes into play and comes to life, let's say, because else you will just go through this and probably not really, not really grasp the concept behind this, because you're also missing to some extent the price action, the behavior behind this. So I, for example, as someone, and that's the main reason why I'm not such an active user of these patterns, is because I think the cleaner my chart, and I can see what's going on there, the better or the more comfortable I feel. So if I draw all these lines in my chart now, and you will see this in the chart a little later on when we have a practical example, you will see there's plenty of colors being used, and I'm not such a big friend of this. So have too many colors in my chart, it's like, yeah. So I don't feel comfortable with that. That doesn't mean that I don't like it or something, but it means that I think it perfectly illustrates that you have to find something which you feel comfortable with, and how you can also work well with then. And in case of a Gartley pattern, then you can also see that if you have a starting point X here, for example, you go up to A, which is very important here. You can see this in the first point. You move from, in this case, AB, which should be a 61.8 retracement of move XA. So in fact, this number here, XA and AB, they have a relation to each other, because this is here, this pattern means that we are retracing a little more than half of the initial impulse here. But this is also possible to draw if you look at a chart and see a sequence of higher highs and higher lows, right? So if we do that simply, and we do it that way, so you can see that now you have also here, to some extent, 61.8 retracement levels. And I have also a sequence of higher highs and higher lows. I can already see we are in a bullish environment. Let's really look at it very, very roughly here. And so I have to favor long engagements. And so we are here about to see the so-called bullish Gartley pattern coming into existence, coming to life, in fact. Even though when looking at the pattern itself, you see other lines being used. Let me just see, how can where do I have it? Here. There's also other lines and other columns being used, which make the whole pattern, or the whole picture, more complex than it, in my opinion, has to be, in fact. So yeah, let's do to this. Let's here use these two lines already, and get an idea. I want to do the following. So I put here in an X, and here I have the A. So, and then the first step when finding such a, or painting such a Gartley pattern in this case. So I will, by the way, also write it here. What we want to look at now is a bullish Gartley. So what we do is we have XA, and from this move here, we now want to see a 61.8 retracement level. Okay, so this number here is 61.8% of this move from X to A in this case. Okay, so here we have now number B. Okay. So now what happens from time to time, probably you've also heard something about Elliott waves. So it's not only that, or let's put it differently. Markets do not tend now to say, okay, I have a push higher, this is the impulse, and then I go lower and then take momentum on from here. And now we see another leg higher and make higher highs. But it's not uncommon, in fact, that the market sees a short bounce and then trades lower from here again. And not only trades lower, but also breaks the former lows here in this case, right? So this is happening quite often, in fact. And after, let me probably also put here, how can I do this? I probably, yeah, let's do it that way. Why not? So let's do it that way. So we have here the blue number. So, and then we point where we write a 61.8 to this. So just to have also the numbers, okay? So, and then you can see that here in this case, the market then moves from A to B, so it's 61.8, and then we see a bounce higher, which marks then our, in this case, C. Okay, this is our level C. And let me put this in black. So also here, it is a so-called Fibonacci level, in fact, because now what we have when we have A and B connected. So when looking at this move here from B to C is 38.2% of A to B. Okay, so this move from here, A to B, is this move lower. This move higher here is 38.2% from this A to B move. So we have now here 32.2%. And you already can see why I emphasized do it yourself, right? So probably wait a little until I have the Gartley pattern file open again, and then make a screenshot and then move through every step which I try to describe here right now yourself, because you will find out, you get a feeling for this. Even though if you probably say this is a little too complicated or that doesn't make sense, it does definitely, and you should go through this yourself, and you will see that you become quite quickly comfortable with it. So this is 38.2% then, and then from there we move lower again to here D, okay? And this is also again black. And this D here in this case now is in fact a so-called, how can I say? It's an extension. Yeah, we have an extension in fact from, how can I say that? How can I do that? Let me see. The extension here is now, obviously you can do B and D, okay? So, and this here, this number is now 127.2. The next Fibonacci number, which we work with, you probably recall this. So this is the so-called, oh, not so good. 27.2%. So what you see here now is an extension. It's an extension of B to C. So, and in fact, it's like you go from here, from this impulse, and then you have 127.2%, where you multiply this push higher here, you multiply this with 1.272, and you get the length from C to D in this case. And then after, some might call this stop fishing. You have plenty of ways to come near to this point. Some might say here, when this point D is marked, obviously we're fishing out all the players who thought probably that now we're taking off again, and then we take off from here. So however you put this, we have then the point from which we take on momentum again, and then we go higher from here. So which means our point to enter the trade is around this region here. So around D, this is our point. And then what is very, very comfortable in this case is it's a purely mathematical construct, which means you have a clear idea of where to enter the market based on which parameters. And also you can say, I work with a quite tight stop, because I know if we're not taking off from here, but the market corrects deeper, the pattern is not given anymore, which means you know very well where to enter the market and where to place your stop. Probably it's based on volatility numbers, whatever, which means then the tighter you use the stop in this case, and if market really takes off from here, the better your risk reward on the trade gets, in fact. And by the way, we can also do one final thing. Probably there's also something of interest. We can also say that this number now here is 78.2%, by the way, of the initial move. So it's obviously forbidden for D to dig lower than X, which is also, by the way, something you might have heard to in some way when it comes to Elliott wave theory, by the way. So here, for example, it's not allowed that after wave 1, a corrective wave 2 digs below 0.1. And in this case here, you have 78.6% from X to D, which means the move from A to D, or when you take the initial wave of X to A in this case. So D here, if you go to X to A, to this line, you will find out it's 78.6% in fact. So this is also how you can get your how you can get your D in this case. So yeah, that's the theory behind this. So you probably can already see why I wanted to go through this here, because if we just go through these pictures, it probably doesn't make that much sense. I think it makes more sense. And now this, by the way, the time you should take the screenshot. You can see that it's not only true for bullish Gartleys, but you can also reverse this process here and look at it from a bearish perspective. So for example, X to A, when we go lower from here, you have a 61.8% retracement. You retrace then 38.2% of the wave A to B. Some might call this also wave A in case of elliott wave. So you have 1, 2, 3, 4, 5, and then you have A, B, Z. Right? And so you have 38.2% here of this wave. Then you push up to D, which is 78.6% of X to A, respectively. It's an extension of 127.2% here of AB. And CD means then that this is the point where we get out, in fact. So, and this is also here described. So what I recommend is go through each point and paint it yourself and get used to this. Probably do this for bullish Gartley, do this for a bearish Gartley, and then you have already a very good idea of the other patterns, in fact. So we have now the bullish bat. So you can obviously see they are not very, yeah, how can I say? They're not very different from each other. In fact, in this case, it's that wave D is obviously deeper than in the first case. So let's go back here. So you see here, this is 78.6. And if you go now to this pattern, you can see that it's a higher extension from C to D. So if you look at it from this perspective, which means, so from B to C, respectively A to B, in this case, AB and CD is obviously an extension, which means you correct more than the initial wave from XA in this case. So in this case, it's 88.6. Again, a purely mathematical construct, and Gartley and BAT patterns are obviously very, very similar to each other. We are only talking about the depth of the corrective move, which is taking place here. Yeah, and that's in fact it already. So nothing more to add here. So we could go through each step now again, but I think that does make sense. I think what makes more sense is to finally have a look at butterfly patterns and then look at the real chart and how to recognize this within the chart and also how to trade it. That's probably even more interesting. And by the way, so did you remember what I said in regards to the Gartley pattern and that you're not allowed to correct more or deeper than X? In case of the butterfly pattern, it's finally allowed to do that. So you can see that here, the market CD or D in general digs deeper than X in this case. So it's some call this a full corrective move with a spike. So it's kind of a stop fishing move. In fact, that's how probably price action theorists or price action traders would call that. What I mean in this regard is, let me just see, what do I have to paint here? So what I mean is, if you have a sequence of higher highs and higher lows, let me probably also extend this here a little. If you have a sequence of higher highs and higher lows, the structure is not necessarily broken if we trade back below this last relative low here. So there's a way to define an uptrend. Some people might say we have higher highs and you have higher lows. And once we now break below here, below this last relative low, this long sequence is broken. This is a way you can define it that way, but there's several cations when you will see the market behaving exactly that. And after a short spike lower, I think this is already a little too much, but let's assume it's only, let's say something like 10% or something below the former lows here. It's let's say 13,500, and now the spike here is 13,400 points or something. And oh, I'm sorry. And then we take off from here again, and the market continues to move higher. So in this case, we fully corrected the last wave in this case. So let's assume this is our wave 5, let's say. So it's on our 5, and we fully corrected it here with this move lower, but the structure was only interrupted. It might be a sign that here we are about to lose bullish momentum, let's say. But it's not said that the structure is broken, especially in today's market or under today's market conditions. We probably, some of you recall the high frequency webinar we did 2 weeks ago. Some of you probably recall the techniques being used from HFTs in this case. So it's not uncommon that we get to see these stop fishing moves, momentum ignition, which is then aiming for regions in which you expect a broad range of orders, stop orders, whatever, to be positioned, take these out, and then take off again. So the problem then with Gartley patterns and also bat patterns is, if you look at them in a very, very similar way, the problem is that they're too unflexible to cope with these, let's call it stop fishing move or fully corrective market environments. And this is where the butterfly pattern then comes into play, because here you have with D level which goes below X, it's fully corrective, but that doesn't necessarily mean that you have a sequence of falling highs and falling lows and a switch to a bearish market conditions, but only stop fishing move, which is probably even more interesting from a risk reward perspective, than because it's not uncommon that the market takes off strongly from these levels. So you can see this plenty of times, not only in FX markets, but also equity markets, commodities, precious metals. So it's definitely a very, very interesting pattern, and probably one which I would definitely look deeper into because of the risk reward structure, even if I'm not a pattern guy or harmonic pattern guy. But in case of the butterfly pattern, and based on my experience and knowledge around the market and market structure, price action here, I would say from a risk reward perspective, this is a highly interesting pattern effect to give it a deeper look then. Yeah, so that's it on Gartleys, on bats, and on butterfly patterns. You probably have seen they all look very, very, very similar. But what we now want to do is we want to have a look here at the, in this case, bullish butterfly. So no coincidence that I use this. When you have it here within the MetaTrader showing, and that you can see this already. So there's a chance to obviously have such a pattern or indicator which draws these pattern into your platform. So yeah, what do we do here? We want to look here at this structure, and in this case we obviously, so we cut it out probably a little too much, because the problem now is that we can't really see that the market finds itself in a bullish market environment. So we've probably cut out a little too much here, because we now plan to trade long from this region here. But let's just ignore this aspect and have a look here now at this pattern to play out. So I'm not sure whether you can see it, but here is the X. You can see the X, market moves up, and there you have your A, okay? So once you have this XA sequence, you wait now for a corrective move. In this case, in fact, it's nearly 100%. So it's something you have to probably be aware of. It's not optimal, let's say. So you have nearly a 100% corrective move. Normally it would be 78.6, okay? But all in all now it's nearly 100. The market bounces back, you get your B here, then it bounces back, you get your C. The C here is now 38.2% of this move, X to A, okay? So this is XA, and B to C is 38.2% of X to A. And then we go lower from here, and you can already calculate where you want to see here your D to be, or where it has to be to fulfill this pattern, because now we have to say, okay, we need 161% in case of this move here lower, of this initial move here lower, right? Then we can see here we have calculated our D, and unfortunately you can't really see it, but there's a stops below written, okay? So after you have your D in this regard, you have your entry point, and then you choose your stop. I wouldn't go without a stop, that's 100% sure, but now the question is how to calculate your stop, what probably works best for you. In this case, I suggest a stop which can be calculated based on an ATR 14, for example. So average to range 14, you look at the time frame you're trading at, and let's say the ATR in this case is 50 pips. You have your point D, then you subtract in case of a bullish sentiment, respectively in case of a bearish one you add, but here in this case you subtract 50 pips. You have your entry point at D, you have your stop point 50 pips below, and then you can also calculate your targets already. So the targets is then the C level here, that's target 1 in my case. So you can see here you have 3. In fact, you have a target 1 which results out of point B. I don't like that, in fact, because from a risk-reward perspective, that's too aggressive when it comes to exiting a trade. In fact, and especially if you're working with a stop, which is 50 pips in this case, for example. So I like to go from risk-reward perspective for C as a first target, and then for A as a second one. Yeah, and then you have already here the price target. So you enter the trade at D, stop calculate based on ATR 14. You go for a test of C, which is then your target on the upside, first target, you take out half of the trade, and then you have a second target, which you can find here at A. While something is noteworthy, once you reach your first target, you can certainly move your stop to break even then. So you're definitely making money on the trade, no matter whether the market continues to move higher, reach point A, or if it drops from here again, and you're stopped out to break even. So at least you made money on 50% of the position then in this case. Yeah, and that's how you could use in this case a bullish butterfly pattern within your trading. And again, it's most of the time, or not most of the time, but all the time, in fact, it's a mathematic approach. It's nothing which is of interest for everyone, but this is also the same for a difference, let's call it, between discretionary traders and quantitative traders. For example, I'm right now, and after years of wondering, who am I, what do I work best with, how can I, or how do I feel when for example, fully automating my trading, how do I feel when I discretionary trade? I found out that quantitative approaches, even though with some discretionary touches, are something which I can work with really well together. Where I function really well under these conditions. The same is probably true for pattern traders who say, I love that. It's clearly formulated, defined where to enter the trade. I have clear numbers, and I work with, in this case, Fibonacci numbers. There's also other traders, technical analysts also, who say, this is a self-fulfilling prophecy, and Fibonacci's do not work in the long run. If you can prove that, it doesn't necessarily mean it's general, or it should be a general conclusion, because it could mean that with your trading style and your way to use these, it probably doesn't work. That doesn't necessarily work or mean it does not work for someone else trading style who adapts accordingly and uses his experience in addition, for example, or something like that. So I think it's definitely a very, very interesting way to look at the markets, and also to formulate your trading ideas, your trading strategies. It's based on geometric price patterns, utilizing Fibonacci numbers. Fibonacci's itself are highly fascinating, especially for someone who loved number theory within his studies of mathematics. So we work here through this, how to get these numbers. we have the weekend right ahead of us. Play around with Fibonacci numbers. I guarantee you will have plenty of fun and find out plenty of interesting stuff. And it won't be, or it won't take too long till you find yourself at Amazon and then Googling for understandable literature on the number theory, and probably also people writing about Fibonacci numbers, and not just Fibonacci's, but also other numbers. You can use them and to draw interesting conclusions, which are, by the way, also very interesting when it comes to computer algorithms, RSA codes, for example. It's probably encode, no encode. How you can or how your emails are secured. I probably put it that way. So there's also number theory, and it's again a very interesting topic. And as we've seen, not only from a theoretical perspective, but also from a trading perspective, when using these ratios then to define precise turning points and predict future movements in your trading. Examples of harmonic patterns include Gartley pattern, bat patterns, and butterfly patterns. We have seen they are very similar to each other. If you understand one, you understand the others automatically. At the end, I think it depends mainly on which risk reward you're looking for, and especially butterfly patterns, in my personal opinion, are very attractive due to this stop fishing move, which is not seldom, or it's quite often the case that it's really a stop fishing move, and after that you get a strong move higher, in fact. Now I can tell you, join us again on Monday. This time it's not Paul, but it's me again, and we will dig into something completely different, but probably even also very interesting. It's the so-called biochemistry of trading, in fact, and I will guide you through answering the questions: what are neurotransmitters? What are neurotransmitters responsible for? And also, how do neurotransmitters affect our trading, and how we can profit from this knowledge, in fact. So I think this is also very interesting. To some, it's probably a little too theoretical, but especially those trying or wanting to dig deeper into the topic of trading psychology, I think this is also very thank you very much. Cryptography. It was cryptography. Yeah, well, we could make it easy, or we could say, let's secure an email. It's cryptography. Thank you very much. That was the word I was looking for. Yeah, but let's come back to the topic from Monday. So biochemistry of trading. I would really appreciate if you join me again, 2 p.m. London on Monday, 17th of February. Check your inbox for the webinar link. All the people who are live right now are already registered, because it's an ongoing webinar. Those watching this on YouTube, feel free to check out the website from Admiral Markets, admiralmarkets.com. Go to the education tab, their webinars, and register for the Trading Spotlight webinar series. And there's the URL once again. Here are the contact details. And at the beginning, we said Admiral Markets, or we pointed out that Admiral Markets is a fully regulated broker. That's why we have to show the risk disclaimer right at the end here. And that's it from my end. So have a nice weekend. Enjoy yourself. Talk to you again on Monday. I really look forward to it. Very interesting topic with biochemistry of trading. See you soon. Bye-bye.